Hi, everyone. We're going to record a really quick segment today. And today I'm presenting to you Asher Freed of Madison Specs and the host of the Real Estate Professional Status podcast. Today, we're going to just quickly discuss cost segregation and how cost seg studies can benefit the average investor. First, let me state, I'm not a CPA, and you should consult your CPA or other financial professional to better understand how these tax reduction techniques can work to benefit you specifically. Now, let's let Asher tell us how these techniques can benefit us in general. Asher, take it away.
All right. Thank you very much, Christy, for that introduction. Yeah, let's get right to it. All right. So cost segregation, really, you got to back up to what many might be familiar with, which is depreciation, right? One of the major advantages of investing in real estate is the ability to take that paper loss, that depreciation that your building is, quote unquote, losing value over time on paper, right? So even though it's producing an income and it's really appreciating in value, because you do plan on selling it in the future at a gain, not at a loss. But since the materials in the building, similar to a car, loses value over time and eventually has to be replaced, you eventually have to do renovations. So the IRS allows you to take that as a loss each year of owning that property. So that's just standard depreciation, that over time the building loses its value. So you are allowed to take that as a loss on your income. So now, where does cost segregation come into this, right? So if you think about depreciation, it doesn't really make sense. Let's say you have a property that's worth $1 million, right? So the standard line depreciation schedule says that over 39-year period, this commercial investment property is going to be totally worthless. The property, the building, not the land, but the building itself is going to be worth zero in 39 years, right? $0, right? Again, we know that it's actually going up in value, but the IRS allows you to take it as a loss. So now, how do you calculate the yearly losses? So standard line depreciation says you divide the total purchase price of the property, you take away the land value, you minus off the land value, which is usually generally like something like 15%. So the $850,000 left in that investment property in our example could be fully depreciated over 39 years. So what the IRS says to do is you'll take that $850,000 and you'll divide it by 39, which allows you to take a little slice as a loss every single year. Now, that makes no sense because there is nothing that depreciates on such a linear schedule, right? Some things in a property break sooner, some things last longer. So that's where cost segregation comes in. Basically, the IRS allows you to have an engineer come down to your property and inspect the building and identify properties that have a lower life cycle than 39 years. There's 5-year properties, 15-year properties, and 39-year properties. So now, if you don't have an engineer, so the IRS tells you got to do the standard line depreciation because that's just the lazy way to do it, and this is how most people do it. But via cost segregation, you could go ahead and identify a large chunk of the building to have a much lower life cycle. So like, who cares about lower life cycles, right? Sounds like science or something, right? But here's the difference.
I care.
If you have a property that costs let's say there's we'll use for an example, $39, toaster oven, right? So if you have that on standard line depreciation, you get to take a $1 loss every single year for the next 39 years. Now, if that toaster oven, which it's identified as a 5-year property, which means that from the IRS's perspective, this toaster is going to break after 5 years, right? Whether or not it breaks, it doesn't matter. You treat it on your tax return as if it's going to break. So you're going ahead and taking that $39 and dividing it by 5 years, which comes out to $7.80. So now, that's more than 7 times your initial return. So now think about the $850,000 purchase. If we could identify, and we usually identify about 15% of a property to be 5 years, depending on the property. Now you could go ahead and divide that total and take a larger chunk over 5 years instead of over the 39 years. So that's what a cost segregation is. It's basically identifying, oh, the table, countertops, lanterns, these are things in the property that have a lower life cycle. So we attribute a value to them, and then you
Okay.
could take larger losses up front, which
Right.
is great, right? But
Yes.
now here's the kicker. In 2017, this idea called bonus depreciation was introduced in the tax cuts that was introduced in 2017, and basically what it allows you to do is those 5 and 15-year properties that we identified, you
Mhm.
could take, originally you were allowed to take all of it up in year one, which means
100%.
100%. Yeah,
Wow.
amazing. It was amazing.
Yeah.
That means, let's say, on an $850,000 investment property, because we're giving 15% away to land, you could
Okay.
get close over $200,000 as losses in year one on your
Wow.
tax return, right? So for some people, that means paying no money in tax, right? Depending on how much your money you're making. So it literally takes you down, it takes your income down. It could literally change your tax bracket, right? It could make you from being in the highest tax bracket to being in the lowest tax bracket. That
Right.
is the power of cost segregation and bonus depreciation. Now we're in 2023, right?
Okay.
So it's has begun to been it's being phased out now. So we're
Okay.
at
So where
80%
is it
bonus.
right now? Oh,
So we're
80%.
at 80% bonus depreciation right now, and next year is going to be 60%. So anyone who really wants to take advantage of this has to jump on the bandwagon, now, or jump
Immediately.
on the bandwagon yesterday, right?
Right.
And the next best time is now. So, literally, but I really want to speak more on the perspective of the passive investor. We're all investing in real estate to add money to our income,
Yes.
right? But it's a double-edged sword, because when you add more money to your income, you might be raising your income tax bracket, and that means paying more taxes across all of your income, right? It means maybe not getting certain benefits that you were privy to before. With taking cost segregation and taking the depreciation losses, it really allows you to invest in real estate and not have to worry about the collateral, the collateral damage or the
Right.
collateral effect of having
Impact.
income. You raise your income, you raise it, and then you also stay in that tax bracket or possibly even lower it, because passive losses work to offset passive gains. So any passive gains you're going to be getting in a real estate investment property, you're going to
Mhm.
be able to offset with your depreciation.
Okay. Wow. So for the average investor, the average passive investor, and that's who's investing in the deals, the self-storage deals that we are currently putting together. If they're receiving, let's say, 8,000 in income and in a distribution, they can count some of that depreciation against that income to effectively, it's not have that be taxable income. It decreases their tax burden. That's amazing. And can you,
Yeah,
so for example, one of the deals that we're working on right now, um, in the first year, the investor will not receive income. Income is paid out in year two. Can you get the depreciation now and roll it forward and use it in the future? Or do you have to, it's 2023, I'm investing in 2023. Do I have to use it on my 2023 taxes?
that's a great, great question. And some people misunderstand this and end up doing the wrong thing.
Okay.
So, to answer your first question, yes, any losses that cannot be taken in any specific year, all that means is it gets suspended and carried over to the next year, which means you don't lose it. It just
Wow,
follows
that's
you
great.
until you end up losing the whole thing. So that's number one. Number two, even if you, like your case, you might not have passive income this year, it still makes sense to do a cost segregation and have those losses, those passive losses suspended. Why? Because if you do it, let's say in 2023, you could tap into the bonus depreciation and carry that bonus depreciation over with you. If you wait and do the cost segregation study once once you're getting that passive income, then at that point, bonus depreciation is already at 60%, and you're not
Right.
going to be able to offset as much. So if you do the cost segregation study in the year that you don't have any passive income,
Yeah.
get to keep more next year as well.
Wow. Well, Asher, look, this conversation, I wanted to just have a quick and easy introduction to cost segregation, bonus depreciation for all of my investors and my potential investors. I really appreciate you taking the time to talk with me. And for everyone out there, you know, DM me, email me, reach out to us, let us understand, you know, how we can help. And you know, if you do reach out to us, Asher is going to send me a little example that shows, hey, if you do 100,000 investment on this type of property or this particular investment, this is what your bonus depreciation could potentially look like. Again, we're not CPAs. Reach out to your actual person and how it affects you, but we want to give you a physical example. And we have a great deal for you for investments right now. So if you do want to roll some bonus depreciation forward and reduce your tax burden in the future, reach out to us. The tax code gives us the opportunity to pay less taxes. We all need to take full advantage of it. Asher, thanks again. This has been great. I really appreciate your taking the time. Have a great day, everyone.
You too,
Bye.
Christy. Have a great day, everyone. Bye-bye.